So let's pass that Texas real estate sales exam with practicing a sample exam test today. We're continuing from Saturday with more questions for the Texas state exam. So this is an example sample test similar to what you might see in your actual exam day. Now, they're not identical. It's not a copy. We can't do that. Okay. It is a sample test. Okay. I had a request to do a sample test, and here I deliver. All right. So so anybody that may be watching it on Facebook, hey, Jaylene, before leaving a comment, okay, please go to StreamYard.com/Facebook and give StreamYard permission to share your name on here. All right. So we're continuing. So let me show you the screen I'm sharing. This is the book that we're using, and I'm going to be posting a link on the comments below later tonight so that if you want to order it, you can click on the link and order the book from Amazon. Because it has, I forget how many questions are in the test. Okay, but it is a sample practice exam. Okay, and oops. So we are continuing with question 41 today. So get ready. Hi, Jaslyn. Thank you for joining us. So anybody who just came on, we are doing a Texas state exam sample. Okay. And so let me get myself in gear and make sure that I am able to share comments with everybody. Okay, on Facebook, on YouTube, and else. Okay, so here we go. All right, geez, I had it ready, and wouldn't you know it, something always comes up. Number 41. The amount of available property that becomes occupied over a period of time is called, the amount of available property that becomes occupied over a period of time is called B, vacancy, B, absorption, C, equilibrium, or D, occupation. The amount of available property that becomes occupied over a period of time. Okay, so you're looking at, properties that are available and they get occupied or they get purchased. What is it called? Vacancy, absorption, equilibrium, or occupation? Type your answer in the chat. So this is like almost a real life real estate exam as you would take it on exam day. Here they have a mix, okay? On your exam day, you will have the national and the state or two separate exams. Okay, so far I've got Sonia says A, Cindy says A. Well, almost, but not quite. So check out what it says. The amount of available property. Okay, it was available, but it became occupied over a period of time. It's called, and so it's not just on rentals, it's also on available property for sale. It's called the absorption rate. Okay, it is how many properties are absorbed within a certain period of time that were initially vacant and then become occupied. So I'll comment on some individuals' comments or questions in just a moment. So the answer here is B, absorption. It's an absorption rate. So absorption is the amount of available properties that become occupied over a period of time, usually measured in square feet. Huh, interesting. Well, you know, a home is measured in square feet. Rentals are also measured in square feet. Okay, so there were some comments on here. And so, hey, hello, Jaylene. Hello, Jaslyn. Hello, Cindy. And hello, Sonia. All right, so somebody took their exam. Okay, so Jaslyn says, I took my real estate exam and passed my national, but failed the state 2 times already. So not to worry. Don't get all stressed out. You will pass it. Just keep practicing lots and lots of questions like we're practicing today. You know, if you listen to the beginning of my videos, I'm like, how are you going to pass that real estate exam? You're going to practice what? Questions, questions, questions. And also learn your vocabulary. You can't make it without your vocabulary. Okay. So congratulations on passing the national exam, and, you know, study a lot of questions. I mean, I was reviewing some questions yesterday, and so just a little bit of how I do it. And even today, I'm not taking exams. Okay. However, I'm always looking for other exams, other tests, other material to share with you. And so I practice the test questions myself. If I miss them, I repeat them till I get 100% score. Okay. Because the more I see it, the more I practice the same questions, the quicker I'm going to be able to answer it on the actual exam day. So don't stop at just 70% or 80% when you're doing practice tests like this. This is an actual practice exam. Okay, so it is not occupation. It is not vacancy. Okay, so vacancy rate is, if you're passing by a motel, they say either no vacancies or vacancies available. That means there are vacant properties. However, the question says it's an amount of available properties that became occupied. So they're no longer occupied. So those properties were absorbed, and that is called absorption. Okay. D, occupation, that's jobs. Okay. So it has nothing to do with occupation. And equilibrium, okay, is a balance. Okay. Or when your ears are in equilibrium, or if your equilibrium is off, you'll get vertigo and you'll be off balanced. Okay. So go back and study vocabulary. All right. I understand what I'm letting y'all know. So please do that. Let's see. Jaslyn says, thank you. I'm so close. I missed both by 1 point. Hey, been there, done that, Jaslyn. You're not alone. Okay. So keep going. I would study more now. Okay. Now that you know, study your weak areas and whatever practice material you're using to take your quizzes at home or practicing. All right, number 42. So anyone that's here from another state other than Texas, you are more than welcome, of course, to stay here, because it's also practice for you, but the state laws are going to be somewhat different. You know, they're not all different, but a lot of them will be. Okay. Good afternoon, Kamanani. Thanks for joining us. 42. The roof of a property costs $20,000. Okay. The roof. Okay. The roof, right above my hat, the roof. The economic life of the roof is 20 years. Assuming a straight line method of depreciation. Straight line means you're depreciating it equally every year. What is the depreciated value of the roof after 3 years? Okay, so assuming a straight line method of depreciation, you depreciate it the same way every year. Okay, and so it says the economic life of the roof is 20 years, right? So what, 20,000 divided by 20, it depreciates what, 1,000 a year. So what would be the answer after 3 years? How much has it depreciated? Or I'm sorry, how much is, what is the depreciated value? What is the current value? Okay, so it depreciated 3 years. How many years is left? So it initially cost $20,000, depreciated 3 years at $1,000 per year, right? That is a straight line method of depreciation. So it is now worth $17,000. So good afternoon, L. So yes, 42B. Very good. So you divide 20 into 20,000, you get 1,000 per year, depreciated 3 years, subtracted from 20,000. So 20,000 minus 3,000 leaves you with what? 17. So that's how many years are left. 17. All right, number 43. Okay. The income capitalized, oops. I meant to show mine. The income capitalized approach to appraising value is most applicable for which of the following property types? Income capitalization approach. Yeah, watch what Kamanani says. Practice, 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 vocabulary, 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 and questions, questions, questions. So what is the income capitalization approach to appraising value? Most applicable for what type of properties? A, single family homes, B, apartment buildings, D, undeveloped land, or D, churches? So what would you be getting income on? It's what you want to ask yourself. So far, I've got 43B by Cindy. Anyone else? Oh, come on. There are many of you on here. Come on. Let's see. Jaslyn, Elle, Sonia, Kamanani, Jaylene. The answer is S43B, apartment buildings, is where the income capitalization approach is used to appraise property. So they compare it with other properties that are receiving income, and they can go by a capitalization rate. Hey, you're ahead of us, Sonia. Man, you've got a crystal ball. You can see the question 44. Just kidding here. So S43B, apartment buildings. Okay. Okie dokie. All right, number 44. Okay, not quite. Oh, come on. All right, there's number 44. So any questions on that one? Go review vocabulary, capitalization rate, income capitalization. All right, 44. In the income capitalization approach, an appraiser does what? Okay, not a realtor, not an agent, but an appraiser. A, estimates gross income and multiplies the gross income and multiplies times the gross income multiplier. B, estimates effective income, subtracts tax, and applies a capitalization rate. C, estimates net income after applies a capitalization rate to it. D, estimates potential income and applies a capitalization rate. No, it is not A. Okay, so the capitalization rate, okay, is after expenses, net income. So C is what the appraiser is going to use. The appraiser on an income capitalization approach, an appraiser is going to use estimates net income after expenses and applies a capitalization rate to it. Capitalization rate could be 8 or 9 or 10, depending what is common with the other properties that the appraiser is comparing to. So S44C. So capitalization rate is on net income. Let's see what the answer says. It says the steps are estimate potential gross income, so all the rent that is coming in, estimate effective gross income potential minus vacancy and credit losses. So if you have 20 apartments, how many are occupied, and you estimate the potential. How much could you get on 20 units, okay, for the year or for the month? And then after that, so that is the potential effective gross income. I'm sorry, the effective gross. Sorry, the estimated gross. So let's say the rent is $1,000 a month times 20 units. That's 20,000. However, you don't have them all occupied. There are some vacant properties. So then the vacancy rate applies and any credit losses. So then the gross income, estimate net operating income, effective income, which was the gross income, all the potential income minus any vacancies, okay, and any credit losses. And then select a capitalization rate compared to the other properties that he or she's comparing to, and apply the capitalization rate. Use the formula income. So let me type the formula. So the capitalization rate, so income capitalization rate. Okay, I'll type the formula on here. All right, is income divided, okay, divided by cap rate equals value. So, and it's the effective income. What actual income are you receiving? Okay, you have vacancies, so you're not going to take those into account. That is projected of what they could have, but what is the actual rate, current income that they are getting? If they only have 10 of them occupied, right? So it would be 10,000 versus the ability to have up to 20,000 a month. And that's what they calculate the current value on. Okay, not what could be, because it's not happening. What if it's a bad area, not enough tenants, not enough jobs? Well, it's not going to attract a higher dollar value, right? So you select a capitalization rate. Well, you actually select a capitalization rate that compares to other similar properties in the area. So that's the formula that you would use. Income capitalization rate. Income divided by rate equals value. So if you have the income and you know the value of the property, then you can come up with a cap rate. However, if we don't know the value, then we use a comparable cap rate of surrounding properties that have similar vacancies or similar occupied properties, and then calculate the value of this subject property. So the answer here was, I had already given you S44C, right? Yes, S44C. So that's the income that you want to use. So go back and look at your math reviews on appraisals and figure out and do some examples on capitalization rate, gross income, net income on rental properties. All right, number 45. 41. So any questions on that? It doesn't seem like a math problem, but it is a math problem. Okay. All right, number 45. Net operating income. Okay, net operating income is equal to A, potential income minus expenses minus debt service. B, effective gross income minus potential income. C, potential gross income minus vacancy and credit loss minus expenses. Or D, effective gross income minus vacancy and credit loss. So net operating income is equal to here we're projecting what could be the most income that this apartment complex could bring. So the answer here is potential gross income minus vacancies and credit loss minus expenses. So the vacancies, it's, some credit loss, you're not getting that potential income. So potential income, so it becomes the effective gross income. So you project the income when it is fully occupied. You subtract how many are vacant, any credit loss, and then minus expenses, which are utilities, property management, maintenance, anything else like that. That is an expense. So number 5, S45 is C. Potential gross income minus, see, it could have been D. Okay, if D had minus expenses, God, I hate the little thing that comes off. So they see on 44, it ended up being estimates net income and applies a capitalization rate. I'm sorry, estimates effective income, subtracts tax and applies a capitalization rate, right? That was number, what was number 44? No, number 44 was C. Right? Yes. So 44, they said estimates net income and applies a capitalization rate. Here it is, what is net income? That one was income capitalization approach for an appraiser. Here you're trying to determine what is the current income of this property after all expenses. Well, the potential income it could bring was 20,000. However, there are 10 vacant, so it comes down to 10,000 minus any credit losses, minus all the operating expenses. Okay, so the answer is C. Let's see. So I know it was the revenue minus operating expenses. Yes. So that's basically it, right? Because if you know what the revenue is, then that's the gross income minus expenses. Okay, you don't even have to actually put minus vacancy. That's what you have. Okay, the potential income is the actual income coming in minus all the expenses, all the overhead. Let's see, Ruth says, my national exam was this Saturday. I need your help, please. I need to pass. Oh boy, don't we all? Okay, and so to pass the national, you'll want to go and review some national questions on some of my YouTube playlist. Okay, I focus just on national. On the 2 series that I have on there, 2022 Q&A Series 1, Series 2, that includes both national and Texas State. The first part of each class focuses on national questions. Okay, and that was Ruth. Hi, Ruth. Okay, so you can go to the Q&A, a playlist, Q&A 1 and Q&A 2 series, and watch the beginning of those videos and practice the national portion. On here, they're all mixed up. So S45C. So you just have to, use common sense. They added all this other stuff to it. Potential gross income minus vacancy and credit loss minus expenses. So basically it comes down to what net income minus expense or gross, all the gross income minus operating expenses. Okay. Same difference. You're welcome, Ruth. Number 46. If net income on a property is 40,000, net income, remember, after all expenses, and the cap rate is 10%, the value of the property using the income capitalization method is A, 100,000, B, 400,000, C, 1 million, or D, 4 million. Okay, so go back to the formula that I posted a little bit ago. Income capitalization rate, income divided by cap rate equals value, right? So what will that give you? I don't have the calculator in front of me, but I have the answers. So 40,000 divided by what? 0.1 gives us what? Use your calculators. Yes, L, Jaylene, and Cindy, 46B, 400,000. That is correct. So it's using the T formula. Right? Do y'all remember what the T formula is? So the T formula, you have the part on top, which is the 40,000. On the bottom, you have the rate times the whole. We're looking for the whole, right? And the rate is 10%, 0.1. All right, number 47. The key feature of an adjustable mortgage loan, called an ARM, is that A, the interest rate may vary, B, the monthly payment increases over the life of the loan, C, the principal balance does not amortize, or D, the loan term can be shortened or lengthened. So what is the key feature of an adjustable mortgage loan? Called ARMs, adjustable rate mortgages. Oops, that's why they didn't use that word, rate. Yes, Facebook user, who is that? Hi, Marcela. Thank you for joining us. We are doing a sample Texas exam. And yes, the answer is A. No, the loan term cannot be shortened, okay? Adjustable mortgage loans are called ARMs, adjustable rate mortgages. That's why I said, I mentioned rate. So an interest rate may vary in an adjustable mortgage loan called ARMs. So they're called ARMs because it's an adjustable rate mortgage. So here they call the adjustable mortgage loan so that they wouldn't give you the part of the answer. So the interest rate may vary. Doesn't mean it will, but it may. Sometimes they're fixed for the term of the ARM, or it could vary depending on the market. All right, so 40. I had an adjustable rate mortgage for 10 years, okay? Started out at 9%. Well, I was lucky. It was an adjustable one, not just at the end of the 10 years. So actually it went from 9 down to 5%. So woohoo! I was happy, and it stayed there until the end of the 10 years. So that was awesome. That doesn't normally happen. Okay. It's just, I bought that investment at a time when the market crashed back in 2006 and 2007. So that's not usually what happens. Okay. Typically at the end of the term, 1, 3, 5, 7, 9, 10 years, it has to be refinanced, or it could vary if they stay with it and it has a cap rate, but others are adjustable during the term of the loan period. All right, number 49. Right, we're on number 4. No, we're on number 48. Gee, I'm getting ahead of myself. Okay, number 48. Why is a wrap around? So you wrap around a mortgage loan. So you've got a loan, you wrap something else around it, another loan, a mortgage around it. Potentially, why is a wraparound mortgage loan potentially interesting to a home seller as an investment? So the home seller is the investor, and they would be selling it to someone else, like on owner financing, with another loan around their loan. So why is that potentially interesting to a home seller as an investment? A, it is a senior loan that can be easily subordinated for additional debt. B, a wraparound, can't see all the answers. A wraparound lender can profit from when the interest rate of the wraparound exceeds that of the underlying mortgage. Oh, it's going to end up being really small. Well, not so bad, okay? Or C, the underlying loan is retired early. Or D, the second mortgage borrower may make payments directly to the first mortgage lender. So why is it interesting to a home seller as an investment? What are we all wanting to do? Make money from our investments, right? So what would it, so the second one says, so that means that the first loan that the owner has is staying in place. He's going to sell it, and a new loan is going to be wrapped around the current loan, and it's going to be greater than what that loan is because he's selling it at a higher price than what the balance on his or her loan is. Now, the advantage of it is that if their loan is a low interest rate, they can charge a higher interest rate based on the current market, or with owner financing, you typically charge higher interest rates, right? Because the owner is taking the risk. If they can get a low interest rate through a lender, then go to a lender. You don't want owner financing. But a wraparound deals basically that it's owner finance, but the initial loan is staying in place. Okay, so you've got the initial loan. Now you wrap another loan around it with a higher interest rate, and it's a larger amount. So if the initial loan was $100,000 and it is now being sold for $200,000, so the new loan of $200,000 would go around the initial one. So the initial $100,000 stays in place. The lender lends an additional $100,000 at a higher interest rate. So the answer here is S48B. Yes, you're right, Jaylene, Cindy. Yes, glad you changed your answer. The benefit is they will make more money on the interest, okay? And get a higher interest on the total amount of $200,000, not just the second $100,000 that's being financed, okay? So they're paying maybe 5% on the original loan of $100,000 that's left over. Now they're selling it for $200,000. That new loan is now, the new buyer is going to pay now 10% on the whole 200. So they make a profit of 5% on the first 100,000 and 10% on the second 100,000, and that's on the wrap mortgage. Got it? Sounds a little confusing, okay? But it's not when you And I understand it very well because I have done that as an investor. And it works out really nice. Why do lenders loan money? Because they make money on the interest, especially when interests are high. All right, number 49. And that's why investors buy property and sell it owner finance. They want to make money on the interest instead of just selling it outright, like flipping a property. Flipping a property is not always the best way to invest, but it is for some if they want to turn their money around quickly. All right, number 49. A builder is required to secure a loan with mortgages on 3 properties. Okay, builder wants to secure a loan with mortgages on 3 properties. This is an example of a participation mortgage loan, B, a blanket mortgage loan, C, a permanent mortgage loan, or D, a bridge loan. Again, all these are vocabulary. So if you've got 3 properties that he wants to use to secure a loan with, what is this an example of? Yes, a blanket mortgage loan. Why? You've got a blanket over 3 kids, right? You got 1, 2, 3. Okay, I need another hand. Okay, 3, and you put a blanket around it. So that is a blanket mortgage. Let's see what the definition says here. A blanket mortgage is secured by more than 1 property, such as multiple parcels of real estate in a development. So in that situation, when the developer or the builder sells one of them, the bank will release 1/3 of the loan or the value of that one particular property. And now the blanket loan covers 2 properties. Okay. And because if they were to have to wait until all of them are sold, man, they're paying a lot of interest. So they want to flip them and turn them around and pay the bank as soon as a property is sold. And so the bank is good with that. Sometimes those blanket loans might be a little bit higher interest because a lot of times they are short term. So who complimented says, you are very good. I think that was Sonia. So anyway, I saw somewhere it says you are very good, or you explain very good, something like that. I missed the comment now. So thank you very much for that. My goal is here is to help you understand, okay, the concept, the question, what is they're asking in the question, okay, and the answer. Oh, here it is. Says, you are very good. Thank you, Sonia. You're so complimentary. I appreciate it. Sometimes I wonder if I am or not. Okay, so hey, we all have sometimes doubt. All right, number 50. Okay, that's a good size. So S49 was B, right? A blanket loan. It's like you have a blanket to cover yourself up to warm up 3 kids. All right, number 50. Which of the following is true of a loan with negative amortization? Okay, negative amortization. Not positive, but negative. Okay. A, the interest rate on the loan increases as the principal balance decreases. B, payments are not sufficient to retire the loan. C, the loan balance is diminishing or going negative. D, additional interest is being added to the monthly payment. So it is a negative amortization. So a normal amortization, right? You have a 30-year loan, and every month that a payment is made, the principal amount reduces and the interest rate amount also reduces. So the equity, the amount of property that we own increases. I'm sorry, the principal amount doesn't, the principal payment, the amount that goes towards the principal increases. The amount that goes towards the interest decreases. That's a normal amortization. But this is a negative amortization, meaning payments are not sufficient to retire the loan. So they're making a smaller payment and it doesn't cover the full principal and interest. Any amount that's not covered, okay, is added to the back of the loan. So the loan keeps increasing, the loan balance keeps increasing instead of decreasing. Okay, so no, it's not D. Additional interest is being added to the monthly payment. No, it's actually added at the end of the loan. Kind of like people were getting, what did they call them? People were being allowed to not make their payments, and the payments were added to the end of the loan. I forgot the term. So the loan amount is actually increasing. Not enough money payment are sufficient to retire the loan. Okay, so the loan is never going to end. It's going to keep getting bigger and bigger and bigger. That's negative amortization. So the answer here is S50B. Gosh, what was the loan they were being, gosh, it's on the tip of my tongue, but I can't remember. So any individuals that during COVID did not make their monthly payments, their loan balances increased, right? Because now they didn't pay the interest. The principal each month wasn't paid. So the principal amount and the interest was added to the end of the loan. So now they're paying interest on interest and bigger loan. Forbearance, that's what it's called, forbearance. They were allowed to use forbearance, meaning skip the payments, but they're added. Yes, Cindy, it just came to me. And they were added at the end of their loan. So many individuals may be losing their homes, okay, because now they're not going to be able to make a larger monthly payment. So Cindy mentioned forbearance, and yes, that's what the word I was trying to think of. Okay, a lot of people were not having to pay their loans and were allowed to apply for forbearance. However, their loans got bigger, and so the interest and the principal they didn't pay added to the end of the loan. So what does that make? Now they're going to be paying interest on some of the added interest and interest on a bigger loan balance. And Sonia said, is that when all those Fannie Mae loans failed? Oh, no. Back then, that was because they were called subprime loans, okay? And there was a major company called Countrywide Mortgage, and they loaned a lot of subprime loans, okay? Lower interest rate loans or not as good loans, and they actually went bankrupt. Bank of America purchased them, and all those individuals, a lot of them lost their homes. Okay, so it was Fannie Mae ends up loaning money or insuring money to lenders, okay, and they can buy in bulk, and so do many other investors, Fannie Mae and Freddie Mac. So let's see here. So Cindy says, yes, foreclosure about to really hit the market. That's right. Some of them have already hit. And Kamanani states, so I can get a home foreclosed. You can get a foreclosed home, not home foreclosed, but that's what you meant, okay? You could also buy a home that somebody lists on the market, and they could actually make enough money by selling it in today's market. However, they can't afford to make the payments. So it'll get sold. Now, if they don't get enough money, then it's called a short sale, and you could purchase it there. Then the lender has to evaluate it and find out the hardship of that borrower and determine whether they will approve accepting less than the loan amount balance. Okay, that is called a pre-foreclosure. Though the owner still owns it, and they're wanting to sell it and prevent foreclosure, right? Because foreclosure damages your credit for up to 7 years. A short sale could be, a couple of years. Sometimes foreclosed homes, it can be less. Bankruptcy will actually do even about the same period. Okay, so you could be able to buy pre-foreclosed homes currently listed with realtors and negotiate with the lender, or buy a home through the lender as a foreclosed home. Once the homes are foreclosed, they are sold by lenders. They're called REO. Okay, they're called REO, which means real estate owned by the bank. Okay, not by the mortgage broker, the mortgage lender. They don't own it. It's the banks that own them. Okay. I know it's a little bit more, but you could actually experience a question like that. Okay, so Cindy made a comment. Assume the loan if anyone is willing to, no credit checks. Well, you can only assume a loan if the lender or the bank is willing to allow an assumption, and they will run credit checks. I don't know of assuming a loan that does not allow a no credit check. Okay, the lender, the bank, is going to have to approve that new buyer that's going to assume that loan. So if you know of one that I'm not familiar with, hey, share it with us. But it's not typically that way. Some VA loans may be assumed, but it has to be by a veteran. And some FHA loans may be assumed. It has to be described, okay, in the deed of trust, okay, that it is assumable. Most loans are not assumable. Okay, so this is what I was saying. REO is real estate owned. REO, real estate owned by the bank. It's a scratch that, no underwriting. Are you a lender, Cindy? Now, you can assume it from a private owner. That would be different. And it's up to that private owner what they want to accept. Okay, they say, hey, my current borrower that I sold it to tells somebody, hey, I can't pay for it. Can you take over it? Let's talk to the existing owner, and he'll refinance it or make a modification and let him do it. Okay. All right. Number 51. Did I show the answer for 50? Yeah. So 50 was B, right? Okay. 51. The loan to value, LTV is the abbreviation, ratio is used as an underwriting mechanism because A, the LTV determines the profitability of the loan. B, the loan amount needs to be less than the property's value. C, borrowers tend to inflate the true value of the property. Or D, a full price loan overfinances the borrower. So what is the loan to value ratio that is used as an underwriting mechanism? Why is it used? So look, loan to value. So you have the loan amount that the lender is going to lend to the borrower, and there's the purchase price amount. And the property has to appraise, right? So the lender is only going to loan if the property appraises way above what they're going to loan, depending on how much the loan. If it's a 90% loan, okay, they want the property to appraise 100%, okay, not 90%, because they're loaning 90 on 100%. So what would the answer be here? See, I've got B. Yes, B. The loan amount needs to be less than the property's value. So if the property is selling for $500,000, the loan amount is going to be maybe $450,000 or 10% less. So a 90% loan. So 100% is 500,000. Okay, 90% would be what? 450,000, right? The loan to value does not determine the profitability of the loan. No, not at all. Loan to value, it's what loan amount are they providing on the purchase price of that property, okay, or the value of the property. And it's going to be less than property value, right? Because the lender wants to make sure that if the borrower defaults, they're going to get their money, that it's going to be selling above what the loan amount is. So loan amount needs to be less than the property value. So those of you that answered B, very good. Marcela, Ruth, Cindy. Okay, remember, on these real estate deals, and they're going to approve the borrower, okay? And they call that debt to income ratio. So how much debt do they have compared to their income? When it has to do with the loan and the property, it is loan to value. How much is the loan going to be borrowed compared to what the value property is? Has to be less than the property value. And debt to income ratios is, you know, how much debt are the lenders going to allow for a person to be able to buy compared to their income. So they'll allow up to, 33% on FHA loans and VAs. They allow higher percentages. So you'll get to learn all that once you interact with lenders and work with buyers. Okay, so S51B, the loan amount needs to be less than the property value. I know I sound like a broken record. However, that's so that you can understand it, since some of the answers typed in the chatty chat were incorrect. All right, number 52. In the past, borrowers were often surprised by unexpected or undisclosed borrowing fees and expenses at closing. This phenomena has been largely corrected through disclosure requirements mandated by which of the following laws. So today they're called closing disclosures, right? CDs, not a CD, a certificate of deposit, right, at a bank, right, to make money. So CD, closing disclosure. So this phenomena has been corrected through disclosure requirements mandated by which of the following laws? A, Equal Credit Opportunity Act. B, Truth in Lending laws. C, National Disclosure Procedures Act. Or D, Federal Fair Housing laws. So what are we dealing with? Borrowers' fees, lenders, expenses. So far, so good. Yeah, it is the, okay, I'll give you a little bit more time. No, it is not C and it is not A. Okay, so the answer is B, Truth in Lending laws. So it says here, the question, in the past, borrowers were often surprised by unexpected or undisclosed borrowing fees and expenses at closing. So lenders weren't disclosing all their fees, okay? and borrowing fees to the borrower. So this phenomena has been largely corrected through disclosure requirements. So lenders now have to disclose when a borrower goes to a lender to get a pre-approval for a loan, they can give them an estimated loan cost and all the fees that go along with it so that they can know what they're paying, what they're being charged for. This was mandated, right? It's for the lenders to be truthful, for the lenders to tell the truth about all the fees. It used to be called the good faith estimate, okay, the lender's disclosure. And so it's almost like a settlement statement. So it's a statement that includes all the a pre-loan expense statement, okay? And a borrower can get a copy of it if they want to see what all their costs are and go and compare with other lenders and get the best rate, because some are going to charge origination points, okay? Can be a point and a half, 2 points. That's 1 point of the loan amount. Those are high costs. So what are all the costs that the lender is charging? Aside from having to pay property taxes, the credit check, the home inspection, the appraisal, okay, the survey, those are costs that are going to be charged, okay? But those are not lender costs. Those are, costs that go along with the loan to make sure that the property qualifies and that the borrower qualifies, okay? So they're truth in lending laws. Okay, so when you saw borrowing fees, who loans fees? Lenders. Okay, expenses at closing. What are they being charged? Lots of closing costs. Some of them are lender fees, some are title fees, some are inspection fees, surveys, appraisals, inspections, all kinds of fees. All that will be itemized in the final closing disclosure, but there's a preliminary settlement statement of all expenses that a borrower can ask up front. Lenders are required to provide that even when not asked, but most people get confused. Okay, it's a lot of information. That's why it's important for them to have someone like us, the realtor, right? So, individuals don't realize how important we as realtors are, because we will evaluate and we'll look at all these expenses and make sure. I just reviewed one for my brother, and they were charging some things on there that they didn't have to. And they said, oh, yes, we have a template that we use automatically. And then after we get all the information, we remove those. Well, I made sure that they got removed, okay, for my brother. That's what realtors are there to do. Not all realtors will review that carefully. They say, nah, leave it to the lender. Well, you got to make sure that they're being truthful to the client. Our job is to protect our client and ask questions for them if they can't ask them themselves, because a lot of times they won't know what questions to ask. Okay? Your job, your career, your business as a realtor is very important, very crucial for borrowers and sellers. So 53? Yes, okay. Okay, so it seems like you all got that. 53, which of the following is an important function of the secondary mortgage market? Not the primary mortgage. That's the people that borrowers go to get loans. This is the secondary market and the background. A, participants borrow funds from banks so the banks can make more loans. B, participants issue tax certificates and sell them to primary lenders. C, participants purchase pools of defaulted loans from lenders to keep them solvent. Or D, participants sell mortgage-backed securities in order to buy pools of loans. So which of the following is the function of a secondary mortgage market? So it's all participants, some kind of participant. So is it participants that borrow funds from banks? Or is it participants that issue tax certificates and sell them? Or is it participants purchase pools of defaulted loans from lenders to keep them solvent. Or D, participants sell mortgage-backed securities in order to buy pools of loans. This can be a tricky one. So the answer here, okay, we've got some D's. Yes, the answer here is D. So participants sell mortgages. Participants sell mortgage-backed securities in order to buy pools of loans. So let me go into detail with the answer from the book. So the secondary market, okay, buy pools of loans. So secondary market organizations buy pools of mortgages from primary lenders, the lenders that we go and borrow loans from to purchase a home. That's the primary lender, the lender we interact with, that our borrower interacts with. The secondary market, we don't deal with those lenders. Lenders deal with those secondary market. So secondary mortgage market organizations buy pools of mortgages from primary lenders and sell securities backed by these pooled mortgages to investors. So investors will come in, buy 50, 100, 1,000 properties that maybe ended up being foreclosed or defaulted loans. So they'll buy those loans. They're buying paper, okay? Promissory notes, and not necessarily the property. So by selling securities, the secondary market brings investor money into the mortgage market. By purchasing loans from primary lenders, the secondary market returns funds to the primary lenders, thereby enabling the primary lenders to originate more mortgage loans. So you'll see when a mortgage was sold, if you've ever had a deed of trust, if you ever had a home that you had a loan, it'll say there, your loan or your security could be sold. So your loan may be sold to another bank or to another major investor. Okay. And that way they can get new loan money amount, new monies to sell to new borrowers in the primary market. So we deal with the primary market. We don't interact with the secondary market. Lenders, okay, mortgagers are the ones that deal with the secondary market. So secondary market buys the loans and returns funds to the primary lenders. And then those loans that they bought, they sell them to other investors. So yes, S53D. So go back and on your vocabulary and look up primary market, mortgage market, and secondary mortgage market. Since some of you didn't want to answer this question, right? However, I did have some D's, some B's, or no, one A and D. So very good. Okay, so do y'all get that? I'll read it one more time. Secondary mortgage market. So what is the function of secondary mortgage market? Okay, they're in the background. We don't deal with them. They are organizations that buy pools of loans, of mortgages, okay, of loans from the primary lender whom we and the borrower deals with, okay? They sell these securities, these notes, okay, backed by these pooled mortgages to investors. So they're selling the promissory note, these securities that are backed by loans, they sell them to investors. By selling these securities Okay, the secondary market brings investor money. Now, the loans that they sold to the investors, the securities that are backed by loans that they sold to investors, these are big conglomerates, other banks, other big organizations. Then they bring investor money back into the mortgage market. Okay. And by purchasing these loans from the primary lenders, the secondary market returns money back to the primary lenders. Because the primary lenders, like maybe Wells Fargo, mortgage brokers, and some of them may service their own loans, but most of them are serviced by a major bank. Well, there are bigger conglomerates that buy those so that these little banks will have more money to loan out and to provide loans through mortgage brokers. So the secondary market returns funds to the primary lenders, okay, by thereby enabling the primary lenders to originate more mortgage loans to buyers, and buyers can buy property through you, and we earn more commission. Got it? So it's kind of like a loop. What goes around comes around. Money comes in, money goes out. And these lenders will sell them at a smaller amount in order to get rid of them. So the pool of investors make money by buying a large number of security-backed loan mortgages, okay? And then they can go and sell them to somebody else for a higher price. So it's investment, okay? It's making money. Money turns. Money makes the world go round, but actually love does. Okay, so that was 53. Number 54, cash flow. Cash flows, okay? Along a river, along a creek, is a measure of how much pre-tax or after-tax cash an investment property generates. To derive cash flow, it is therefore necessary to exclude what? A, cost recovery expense, B, interest expense, C, loan principal payments, and D, net operating income. So to derive cash flow, it is therefore necessary to exclude So cash flow is money that's coming in. So it's a measure of pre-tax and after-tax cash an investment property generates. So to derive cash flow, it is therefore necessary to exclude what? Is it net operating income, loan principal payments, interest expense, or cost recovery expense? No, it is not net operating income. Okay, we don't want to exclude net operating income. That is actually our cash flow. Net operating income is our cash flow. But the question says to derive cash flow, okay, net operating income, cash flow. It is therefore necessary to exclude, okay, remove from the picture, right? Because you've got pre-tax and after-tax cash. Exclude cost recovery expense. Okay, cost recovery expense. Okay, it can't be net operating income because that is the actual cash flow after all expenses, right? However, net operating income, taxes haven't been paid on it, right? And then if there's a lot of write-offs, then they may not have to pay any taxes. So let's see what the book says. So cost recovery expense. Cash flow is the difference between the amount of actual cash flowing into the investment, that is your gross income, of actual cash flowing into the investment as revenue. So that's gross income. And out of the investment for expenses, debt service, and all other items. So cash flow concerns cash items only. And then, oops, sorry. It says cash flow concerns cash items only and therefore excludes depreciation, which is not a cash expense, right? Depreciation happens every year. The government allows, IRS allows to depreciate a property, an investment property, 27 and a half years. Okay, so that is not part of the cash flow, but it is a tax shelter, reduces the amount of tax that will get paid. So cost recovery expense. So depreciation is not a cost recovery. So you made an investment, a major cost. Now you're getting money back from our investment. And so there's certain things that we have to exclude, right? Because some of it is pre-tax cash, some of it is after-tax cash. So it's called cost recovery expense. Cash flow is the difference between the amount of actual cash flowing into the investment, a rental apartment or a home, as revenue, and out of the investment for expenses. So it's taking it out, it's the money that's coming in, okay, into the investment as revenue, and from the investment for expenses. So you get money as profit, money to pay expenses, and all other items, debt service, and all other property management, maintenance, overhead, all that. So cash flow concerns cash items only. So that is the actual profit left over, cash, not depreciation, which takes place during income tax time. Okay. That happens at income tax time. So that's not cash on hand. That is not considered cash flow. It is a benefit. That's why people invest. But it's not cash on hand. Oh, well, you can't see my expression. So I was saying it is not cash on hand. So those who answered net operating income, no. Okay, we're dealing, that's the cash flow. That is the cash money we have on hand. Loan principal payments, no, that's the payment that is made on the principal amount of any loan. Interest expense, that's the interest on the loan that we're paying. Okay, that is also deducted, but not at the actual cash flow. It's done at tax time. Okay. So it is called cost recovery expense. So what is the cost you made for the investment? And are you recovering more than that cost, okay, by all the cash flow that's coming in, and you deduct all the expenses, and now you have your cash that you can utilize and put in a savings bucket in case you have emergencies. All right. Okay, of course, this is not like a real life exam where you're going to have an opportunity to tear these questions apart. That's what I'm here to do, to help you understand them. Right? So nobody answered that one. Oh, yeah, somebody said B. And the answer was actually A. Okay, cost recovery expense. Okay, number 55. The method for deriving an investor's return on investment, ROI, is by what? Method to derive an investor's return on their investment. So they invested $500,000. What is their return on that $500,000 every year? A, dividing net operating income by cash flow. B, multiplying the required yield times after-tax cash flow. C, dividing net income by the price paid for the property. Or D, multiplying cash flow times the price paid for the property. So you bought an investment for $500,000. Now you're getting money back. So do you do it with the gross income or with the net income? Net income is after all expenses, right? That would go along with return on investment, your ROI. So it is Anybody answering that one yet? No. Okay. So you'll want to go look at what is this under financing and check all the investment mathematics, finance questions, finance calculations. Hi, Colin. So the answer is C, right? It's dividing your net income by the price paid for the property. So the investment is the price paid for the property. So how much profit, well, I shouldn't call it profit, but that's cash profit, is the net income after all the expenses. Okay, that is the cash flow, return on investment. Now, at tax time, they're also going to take in depreciation and interest paid on the loan and property taxes. Okay, but that's not the cash on investment right now, the ROI. So it's dividing net income by the price paid for the property. No, it is not net operating income by cash flow. Okay, so dividing net income by the price paid for the property. Okay, that's how it's determined. Investment by cash flow or net income, sorry. So go back and review vocabularies on the definition or the formula for ROI, return on investment. The method of deriving an investor's return on investment is dividing net income, divide that by the property price paid, not the current value. You want to know, I invested this much money. How much am I getting back? Okay, from the net income. There are other ways that they're going to make more money, as I mentioned, through depreciation and other things like that at tax time. That's why these are called tax shelters, right? Awesome tax investments. So let's see. And I got the answer right, but almost said A. Awesome. Yes. The first one says dividing net operating income. It's dividing net. It's normally gross income, gross operating income, and it's not by cash flow. Cash flow is almost like the net income, right? It's the money you got right now. It's the cash flow that's coming in right now. It's net income divided by the property value. Okay, not by the cash flow. Okay. Investments are always compared to the original amount of money you paid for a property and improvements. So you've got a basis on the investment, and then if you added improvements, paid thousands of dollars, that is added to the investment. Oh, darn it. Okay, there's 56. All right, so 55 with C. All right, number 56. Which of the following items would affect a homeowner's adjusted basis? Okay, I just mentioned a basis, right? Which is the original value we paid for a property. So which of the following items would affect a homeowner's adjusted basis? So the basis of a property. Then you can do stuff and then you have an adjusted basis. A, installing a higher capacity air conditioning and purifying system. B, replacing a washing machine. C, stripping and staining hardwood floors. Or D, replacing a broken picture window. What would increase the value of the property, which adjusts the original homeowner's value? So which item would affect a homeowner's adjusted basis? The basis is the original price of the property. what would change the basis to a higher basis so that when the property is sold, they don't go with the original price purchase to take into account any profit for capital gains. Now you added certain things that improve the value of that property. So now it's an expense that can be added to the original cost of the home. Which one makes sense that it would be added to the cost of the home as an improvement and would now become the new value? Yes, very good, Jaylene and Ruth. Installing a higher capacity air conditioning and purifying system. That changes the value. That is an improvement on the property. So if the property initially cost $500,000 and they added $10,000 or $15,000 system, the new basis is now $515,000. So the day they sell it, if they sell it for $600,000, they get to deduct $515,000 as their new adjusted basis. Okay, that's an example. Washing machine, stripping and staining hard floors. No, they didn't change the hard floors. Replacing a broken picture window. Well, that window was already there. It had to be replaced. Okay. That doesn't improve the value of the home. That is maintenance. Fixing, repairing. Sometimes it's called deferred maintenance. If we live in a property for many, many years and don't do any repairs on it. Okay, number 57. Which of the following is true with respect to real property taxation by the federal government? Okay, so this applies nationally, right? Which of the following is true with respect to real property taxation by the federal government? A, it imposes ad valorem property taxes and capital gain tax. B, it may not impose property taxes or tax liens. C, there are no federal ad valorem taxes on real property. Or D, it imposes ad valorem tax, but not capital gain tax. This is a challenging question, it could be tricky. So which of the following is true with respect to real property taxation? So those are the property taxes, okay, by the federal government. Okay, property taxes are imposed by the local government, okay, the county. The county, the city, okay? Property taxes are different with every city, within the county. So what would it be? It may not impose property taxes or tax liens. B, C, there are no federal ad valorem taxes on real property. Or D, it imposes ad valorem tax, but not capital gain tax. Well, it's not D, because they do capital gain tax. And it may not impose, it doesn't impose property taxes, but it could impose tax liens. Okay, federal tax liens, IRS tax liens. It imposes ad valorem property taxes, no. So the federal government does capital gains. Okay, so there are no federal ad valorem taxes. This is the property taxes that are added to every single property, okay, that you purchase. So it'll charge city tax, county tax, road tax, trash tax, city schools tax, college tax, all kinds of taxes. And that ad valorem property tax could be 2%, 3%, 2.5%. Okay, that's what we pay every year. So federal tax, federal government doesn't do ad valorem property taxes on real property. They can put IRS tax liens, okay, on a property. And there be capital gain taxes that may be paid depending on whether the home was an investment or whether it was occupied and followed certain rules. But the correct answer here is there are no federal ad valorem taxes on real property. So the answer says the Constitution of the United States specifically prohibits such taxes of ad valorem by the federal government. However, tax income derived from real property and gains realized on the sale of property are part of the federal government. So if you get income, rental income, we pay taxes. We sell the property and make an investment and it was not our primary residence, then we pay capital gains, unless a 1031 exchange was done. That's another way of using some type of cash tax shelters. Eventually somebody will pay, but not the current owner. Okay, so 57C. Oh, I forgot to type as 56. What was 56? 56 was A, and S57C. Okay. So on Facebook, I hadn't typed answer for 56. So Colin says A. No, so federal government, does not impose ad valorem property taxes. Okay, those are the property taxes we pay every year. It's the ad value, okay, property taxes. We can pay capital gains. So B is not correct because it says property taxes and tax liens. Federal government can't put tax liens on a property if our income taxes aren't paid. All right, and then D says it imposes ad valorem tax, but not capital gains. Well, no, it does capital gains. So should you become an investor, you may or may not deal with capital gains. Depends on type of investment you buy. All right, number 58, the short-term capital gains and long-term capital gains. Number 58, ad valorem taxes are based on A, the replacement value of the property, B, the assessed value of property, C, the millage value of property, or D, the broker's estimate of value. So I just talked about ad valorem taxes, right? So hopefully you'll get this one right. Hey, yes, got it. Everybody got it. The assessed value of the property. Awesome. Very good. 100%. Okay, I'll give you an A+. Okay. All right, number 59. Moving right along. A retirement facility prohibits ownership of any unit by persons under the age of 55. The association claims it has made the prohibition properly. Which of the following is true? So it's a 55 plus community. Did they follow the correct rules to make sure it was a 55 plus community? So the answers are A, they are violating the Civil Rights Act of 1866. B, they are violating the Fair Housing Amendments Act of 1988. C, they are guilty of age discrimination. Or D, the prohibition may be legal if performed correctly. So a retirement facility prohibits ownership of any unit by persons under 55 of age. Okay, so it's for retirement. Do they want kids running around? Well, and if they don't, what do they have to do? They have to follow certain applications and processes to become labeled 55 plus community. Yes, the answer is D. They can't just say, oh, we're a 55 plus community, right? And just do it. No, that would then be discrimination. Okay. If that retirement facility did not follow the right rules, okay, to apply for that, and they have to prove it and justify it, then they would be violating the Civil Rights Act, right? Violating Fair Housing Amendment Act of 1988 on age. However, the prohibition may be legal if it is performed correctly. And to be a 55, a retirement community, they're going to do that. Number 60. Guess I got to make myself smaller or disappear. Voila, I'm gone. 60. An owner suddenly pulls a property off the market after hearing from the agent on the phone that the agent had received a full price offer from a minority party. The agent then informs the offerer that the home has been removed from the market and is unavailable. Which party or parties, if any, have violated fair housing laws? So the owner suddenly pulls the property off the market. The agent then informs the offerer that the home has been removed from the market and is unavailable. So which party or parties, if any, have violated fair? A, the agent only. B, the owner only. C, the agent and the owner. Or C, the agent and the owner. Or D, neither agent nor owner. So who violated, if any, the fair housing laws? Awesome. Very good. Yes, the owner and the agent, or the C, the agent and the owner, right? Because the realtor shouldn't have removed it off the market for that. They should have fired their client or advised their client, you are discriminating, that is illegal. Cannot do that. And then later on, bring it back on the market after that buyer disappears. Okay, so that realtor is lying to others because the owner removed it off the market after hearing from the agent on the phone that the agent had received a full price offer from a minority party. So in essence, the realtors performed, right? They brought a ready, willing, and able buyer, and we should get paid our commission. However, the agent should have advised the owner that that's illegal, can't do that. You get it, you take it off the market, you owe the commission. Okay? And that buyer could take you to court for discrimination when you end up bringing it back on the market. Very good. Okay, we've already done 20 questions, so you let me know. Do you want to do a few more? It's already 7:33. A lot of times we're on here for an hour and a half, 2 hours. So I'm at your mercy. You let me know. I've got the time if you got the time. So if you got the time to do some more questions, I got the time to go over some more questions and answers. We've done 20 questions, okay, from a sample Texas exam, similar to what you will deal with at the exam. But of course, we're going through it in detail and explanations so that you can better understand it. So what's it going to be? More questions, or no? What's it gonna be? Okay, for those of you that are watching the replay, right, you don't have a choice, right? If those that are here live, that's who I listen to. And they're saying, keep going. Yes. Let's go. All right. Woohoo. Let's go. Okay, so a little moment here. Who is this? This is Wild Lillie Hendy from coming to you from San Antonio, Texas with YouTube Agent Prep. If this is your first time to my channel, YouTube Agent Prep, hey, tap that subscribe button, click that little bell so that you're the first to get notified every time I go live Monday, Wednesday, and Saturday. And tap that thumbs up. Send me some love if you're on YouTube now. And I'm going to check and see who's on YouTube now and see how many thumbs up I have. Actually, the majority of you are on YouTube. So click that thumbs up. Okay. No thumbs down, man. I don't want no thumbs down, man. I'll cry. Okay. So give me some love. Send me some love. Okay. I'm almost at 1,000 subscribers. That's been my goal for a while now. That's one of the big criteria with YouTube. So I go live Monday, Wednesday, and Saturday. So Monday, Wednesday at 6 p.m. on the request of Cindy Cook, right? I added Monday. And on Saturdays at 10 o'clock, and that is Central Standard Time. And y'all, I am also a realtor, okay, practicing realtor with eXp Realty. Okay, we got time. Keep going. All right, here we go. $61. Hey, and Colin is moving from or getting his license for Texas. He's already a realtor with eXp in California. Hey, so Colin, tell him how you like eXp, man. Type it on the chat, right? He chose eXp and he found me online on YouTube. So when you're ready to start interviewing, hey, give me a call, set up an appointment with me, and let's chat and talk about eXp and all the benefits. 61, which of the following are examples of closing items not prorated between buyer and seller, right? When you go to a closing, there's a contract, certain things are prorated. Which of the following are not prorated? A, taxes, B, inspection fees, C, utilities, or D, condominium assessments. Oh, Jaylene is eXp from Houston, getting your broker license, right? You're getting your broker license. I forgot about that. So Colin says, wash hands, love eXp, great company, great network, sky is your limit. You got it. Okay. Oh, no, it is not A. So which of the following are examples of closing items not prorated, okay, between buyer and seller? Taxes, inspection fees, utilities, or condominium assessments? It is inspection fees. Because inspections are paid by the borrower. Well, the seller could end up paying for it, but those are not prorated, right? That's an expense that gets paid to the inspector for inspecting the home. Taxes are prorated, utilities can be prorated, and condominium assessments can be prorated. Okay, but not home inspection fees, well inspection, septic inspection, roof inspection, AC inspection, plumbing inspections, all kinds of inspections. Okay, those are not prorated. That is basically for the borrower to know and be objective on what they are purchasing, to be aware of what they are purchasing, the condition of the property, and any improvements. So I'm curious. So Jaylene, I'm just curious. Are you getting your broker license? I think I misunderstood because you say you're already with eXp. Anyway, just a side note here. 62. Which of the following activities is not allowed under the Real Estate Settlements Procedures Act, which is goes for RESPA. That's the acronym is RESPA, Real Estate Settlements Procedures Act. A broker having any business relationship with an insurance company that is involved in the broker's transaction. B, a broker pre-qualifying a buyer for a mortgage loan. C, a lender requiring a deposit from a borrower for a tax and insurance escrow account. Or D, a lender paying a fee for a broker for referring a borrower to the lender. Which of the following activities are not allowed under RESPA, Real Estate Settlements and Procedures Act? So anybody answering? Oh, so Jaylene says, no, just real estate agent, lots of left. Oh, so your friends that are real estate agents are EXP. You're not a realtor yet. They're just helping you get the courses. Got it. So I expect that you're joining EXP. Okay, Cindy says 62B, a broker pre-qualifying a buyer for a mortgage loan. No, not correct. So which of the following activities is not allowed under RESPA? So we can pre-qualify a buyer for a mortgage loan. Like we can ask them questions before we send them to a lender. The answer is D, a lender paying a fee to a broker for referring a broker to the lender. Okay, so that is a no. They might be able to provide a gift just like we provide a gift for a referral, right? A $50 gift, but not paying a fee. Very good, Jaylene. See, A was a broker having any business relationship with an insurance company that is involved in the broker's transaction. Right, that is not in the Real Estate Settlements and Procedures Act. C, so which one is not allowed? Okay, it's paying a fee. So a broker can have a business relationship with an insurance company, right? Because that borrower is going to need an insurance company. The insurance, 1 year insurance is going to be going into the settlements statement, the closing disclosure. They have to buy 1 year's insurance. Lender will require that. And we can pre-qualify a buyer, verbally, find out whether they meet certain things or not. A lender requiring a deposit from a borrower for a tax insurance escrow. Yes, that's the escrow account, like a little savings account to pay for property taxes and insurance when they come due every year. So the only one that cannot be done is the lender paying a fee, right, for a broker for referring. So somebody also refers to someone, we can provide a gift, a $50 gift, but not a fee. That is a payment. We only receive payment from our broker. Or when we're mentoring somebody, we do get a mentor fee. And that is paid directly to us by the mentee. Okay, so here's Malik. Said Malik wanted to hop on and say, after taking these classes, I was able to pass my exam. Thanks so much. You're very welcome. Congratulations for passing your exams, Malik. Says, yeah, congratulations. Awesome. All right, so the answer is 62D. All right. Number 63. Which of the following communication records must, as opposed to should, be kept? Which one communication records must be kept? A, notes on every conversation. B, copies of required communication to principals. C, notes from company training sessions. D, business cards or licensees one meets at open houses. Which one of the following communication records must be kept as opposed to should? And we use it to CYA, cover your what? Your rear end, right? It's like we put everything in writing for security in case somebody wants to complain. Yes, that is correct. 63B, copies of required communication to principals. Okay, nowadays we text, we email, we send little videos, we share documents on at EXP, we use SkySlope, okay, to share documents. So it keeps a record of it and we can write notes on there or keep our own notes separately. In the past, I used to have to handwrite notes or type them and keep them on each record. So now we use so many different forms of communication that you can also keep copies of emails, I mean, anything. Or you must keep them in case somebody does decide to complain. Okay, number 64. Darn it, didn't all come out. So I wonder if I change the font to Ember. No, that didn't work. Okay, never mind. Go back to what works. We're getting there. Okay, I'm trying to get all of 64 on one screen. Gonna have to be smaller. Okay, there we go. Number 64. To minimize the risk of violating fair housing laws, a licensee should do what? A, refuse to use terms that refer to or describe any of the classes of persons protected by the law. B, to avoid working in neighborhoods that are predominantly occupied by single ethnic groups. C, make discriminatory or derogatory remarks in conversations only, never in writing. Or D, give better service to members of a protected class that is standard for other clients or customers. So to minimize the risk of violating fair housing law, licensees should do what? Type your answer in the chat, the chatty chat. Okay, you guys are dwindling a little bit, getting tired on me. Yes, 64A. Oh, not D, Ruth. So 64A, to refuse to use terms that refer to or describe any of the classes or persons protected by the laws. If we don't use them, we won't have any issues. D said, give better service to members. No, we cannot give them. We're discriminating, okay? To give better service to members of a protected class that is standard. No, they receive the same service that we give to everyone else. Because why? We're doing the best that we can for everyone. We're being the best of me. I am being the best of me that I can be with everybody. Okay, not just with some. Okay. So no preferential treatment. You know, we want to be sensitive and aware. Or and yes, get it. So Ruth gets it. All right, good. 65. What are tenant improvements? What are tenant improvements? A, modifications to a rental suite. Oops. Sorry, my mouse fell. Modifications to a rental suite to conform to a tenant's usage specifications. B, marketing programs that yield a higher quality of tenant. C, increased revenue resulting from a rise in rental rates. Or D, increased occupancy resulting from a population increase in the market area. So what are tenant improvements? This one should be hopefully an easy one. We're helping a tenant, right? And a tenant decides to do some improvements. So what is that? They're renting a house or an apartment, a condo, a townhome, a boat, you know, anything. A modification to a rental suite to conform to a tenant's usage specifications. Of course, the landlord can make that on the request of the tenant, especially if they're a disabled tenant, okay? Or the tenant can do them on the approval of the landlord. Okay, let's see. Somebody answered anything else? Nope, not that many answers, but everybody answered A. Very good. Do y'all hear my country western music on the background? It's kind of light, but I like to have music. All right, number 66. For the proper handling of clients and owner monies, a property manager is usually required to do what? A, deposit all funds every month in the management firm's central operating account. B, employ a notary to witness and record every deposit or payment received. C, maintain a special trust account in a qualified financial depository. Or D, disperse all funds to their legal owners on a weekly basis. So put yourself in the shoes of a property manager that has hundreds of apartments or homes that they're managing for a client. What would they do with the monies they get? Come on, type your answer in the chatty chat. Yes, very good. C, maintain a special trust account in a qualified financial depository. So why don't they just use bank, right? No, because there's different terms on how banks are referred to as a qualified financial depository. It could be some other financial institution and not just a bank. Typically, so that is what a bank is, okay? A financial depository, qualified business. Very good. Number 67. I have a feeling that's going to be a long question. Oh, no, not too bad. Numbers. Okay. Number 67. Jennifer advised her clients they needed to paint their living room before showing the property. Okay, so Jennifer is a listing realtor, right? The walls on these rooms were 8 foot high. The wall of these rooms were all 8 foot high. The wall lengths were 14 foot, 18 feet, 16 feet, and 18 foot. Oh, that's weird. The walls of the rooms were 8 foot high. The wall length, okay, the width, 14 feet, 18 feet, 16 feet, and 18 feet. If a gallon of paint covers 200 square feet, how many whole gallons would the home sellers have to buy? So you have 8 foot high and widths of 14, 18, 16, and 18. So they needed to paint their living room before showing the property. So the living room has different lengths of walls. So how many gallons do they need to cover? If a gallon of paint covers 200 square feet, first you got to calculate what? How many how many whole gallons would the home sellers have to buy? So get your calculator. So how are you going to figure this one out? So you got to multiply the 8 foot high by each of the wall lengths, right? 8 foot times 14 feet, 8 foot times 18, 8 foot times 16, 8 foot times 18, and then add them all together. And then you'll know how many square feet that is. So according to the answer here, it says it's a total of 528 square feet. There will therefore need to be 528 divided by 200 square feet, right? Every gallon covers 200 square feet, but we have a total of 528 square feet. So how many gallons would they have to buy to cover all 528 square feet? 8 feet times 14, 8 plus 8 feet times 18 plus 8 feet times 16 plus 8 feet times 18 equals 528 square feet. Divide that by 200 and it's going to be like, 2.5 gallons. So we don't have 2.5 gallons or 2.25 gallons. So we round it off to the larger gallon, right? Because 2 gallons is not going to be enough. So the answer is C, 3 gallons. Very good. Oh, wait a minute. Y'all haven't answered that one. So it is 3 gallons. They won't use the whole 3 gallons because 3 gallons would be 600 square feet. And why is it square feet? 8 feet. 4 times 14 feet gives you a total of a number and square feet, right? 8 times 4 is 32. And 8 plus 3 is 11. So 112 square feet. Feet times feet gives square feet. So whenever you're multiplying base times height, the wall times the length of the wall of the room of one wall, it's square feet. And you'll have a little extra over to use for later, right? Or the seller will. They can leave it behind to the buyer so that the buyer knows exactly the color of the paint that was used. So instead of throwing the gallon away, they leave the gallon of paint behind with the color so the borrower, the new buyer, knows in case they want to repaint the other rooms or repaint or touch up. Okay. Number 68, an investor just purchased a rectangular 2-acre retail lot for $250 a frontage foot. Okay, so they bought a rectangular 2-acre retail lot. The frontage of it is $250 a frontage foot. So every foot on the front of the property, which is along the street, is $250. So if she paid $100,000 total, what was the depth of the lot? Okay, we have to use the, oops, there goes my unwind alarm, 8 o'clock. This will be in multiple steps. So you've got 2-acre retail lot, rectangular. So 1 acre times 2 acre. Okay, it's rectangular. So one side is longer than the other one. So it is 2 acres, and each acre, right, is 400. Oh, how many feet in 1 acre? I was just going to tell you that. So I want you to type it in the chat. How many feet per acre? I remember it by 7-Eleven. You're going to say, what the heck, 7-Eleven? Yes, 43,560 square feet. Why do I remember it as 7-Eleven? So as Colin said, the first 2 numbers total 7. The last 3 numbers total 11. The larger number, 4, and the 6 are on the outside. So for me, it's 7-Eleven. My family likes to gamble. Okay, so shooting dice, 7-Eleven. Other individuals remember it as 4 realtors going down 35, Interstate 35, going 60 miles an hour. That's a long way to remember it for me. So I like 7-Eleven. Okay, so you've got 560 square feet. The frontage is in feet. So we need to do some conversion, right? So you have 2 acres, right? So you're going to have to multiply. So let me explain here the formula. So they actually use the T formula. Since the investor paid $100,000 total, and that equals to 250 per frontage foot, there are 400 feet frontage. So if the property is 2 acres, it totals to 87,120 square feet, right? 560. So 43,560 times 2 equals, what was it? 87,120. Okay, that's square feet. That's what 2 acres equal. Okay, 87,120 square feet for the 2 acres. So then it says dividing this by 400 produces a lot depth of 217.8. Okay, but they don't say, oh, excuse me. They don't say how they got the 400 feet. So, but what the equation does is they divide 100,000 divided by $250 of frontage. So the cost of the property is 100,000, and they divide it by 250. And they get 400 frontage feet. I feel like something's missing here. So since the investor paid 100,000, and that equals $250 per frontage foot, okay, there are 400 frontage feet. And they calculated that by 100,000 divided by 250. Okay, so 100,000 divided by 250 equals 400. 400, oops, not $400, but 400 feet. Actually can't type. Okay, so that was the square footage, and this was how many feet are frontage. 250 feet times 400 is the frontage. Okay, because it's going to be frontage times length, okay, to get the whole 2 acres. Okay, so if it's 100,000, one side of it is 250 feet, is $250 per foot. That's the front. So it gives us 400 feet of frontage. So now from the frontage, so now we dividing this by dividing the 87,120 by 400 feet, okay? Because base times height equals the total acreage, right? So if you have one side of 400, you divide that on the total acreage and you get the other side. So square feet divided by foot equals feet, okay? So the answer is, yes, 400 feet. So if you want to go work it backwards and you multiply, so they ended up getting, hold on. They ended up calculating the depth of 217. So wait a minute. No, the answer is not A. No. Sorry about that. It says, what is the depth of the lot? So they have the frontage. The frontage is 400 feet. That's what we calculated. I'm going to delete the comment because it's not 400. I saw Cindy type A and I typed A, but it's not A. Okay. I says I can't put me on timeout. Okay. So it is not 400. That's what we got from dividing 100,000 divided by $250. Okay. To get how many feet in the frontage. So the frontage is 400 feet. So now we divide 400 feet into the whole square footage, 87,120 square feet, to get the depth, which they call the, the back end, the length of the property, since it's a rectangle. So it is 218. The answer is 217 and change, 217.18. So they rounded off to 218 feet. Okay, so that answer is S. Sorry for the confusion. I saw somebody else's answer and I typed that. Me bad. So if you calculated it and you found that it was 217.8, and the answer says 218, then they rounded it off. Oh my gosh, I can't seem to, I'm losing my brain here now. Okay, so. Okay, did y'all get this? It's a multiplication and division, okay? Because the property said it's a rectangular lot. So length times width. So one side is going to be longer than the other, right? If it was a square, the sides are equal, but it's a rectangle. So the frontage was calculated by dividing $250, which is per foot on the front along the street, into the 100,000. They came up with 400 feet. Well, that is the front part of the property. So that is, it has lots of frontage. But now it said if she paid 100,000 total, what is the depth? Okay, the frontage is 400. The depth is 218. And if you think about how a rectangular is, it's got one long side and one short side. So the front, it has a lot of frontage, and the depth of it is shorter, 218 feet. Okay. Okay. Nobody said okay, but I say okay. So no one actually calculated that one. And you know what? And that's okay, you all. When you get into your exam, skip the first 5 questions, skip the math problems, go do all the easy ones, and then come back to the difficult ones later. And if you don't do a math problem, it's not going to kill you. Okay. You're not going to fail the test if you miss one math problem. But go ahead and answer it. Okay. All right. Number 69. Andra can afford to spend $5,000 in closing costs to refinance her home. Okay. $5,000 closing costs to refinance the home. The lender quotes closing costs of $800 plus 2 points. The house appraised out at $240,000, and she gets an 80% loan. Can Annika afford to refinance? Okay, so let's look at the question. She has $5,000 for closing costs. The lender is charging 2 points, and the 2 points is from what? The loan amount, not the purchase price, not the appraised price, but from the loan amount. So the appraised value is 240, and she's borrowing 80%. So first is 80% of 240 is what? So you multiply 80% times 240. So what is that? Somebody has a calculator? Who has a calculator? So 240 times 80%. So that's 32, that's 16, that's 192,000. Right? Yep, it's 192,000. Okay, I calculated it on my head. So that's 192,000. All right, that is the loan amount. So now she has to pay 2 points on that 192,000, right? Because 2 points is equal to 1% of the loan amount. So, 1 point is 1% of the loan amount. 2 points is 2% of the loan amount. The loan amount is 192. So 2% of that is what? So 192 times 0.02 equals what? So 192 times 2 equals 3384. No, yeah. Oops. 3384. However, okay, now you have to add 800 because it says 2 points of the 80% loan plus 800. So 3384 plus 800, okay, equals 4640. So can she afford to refinance? I think Cindy answered C. Said yes, with 36 left over. I'm sorry, with 360 left over. That is correct. So S69 is C. That's right. So it was 4640 is the total cost of the 2 points of an 80% loan plus $800. leaves her with $360 left over. So Annika can afford to refinance. Very good. That was a several step math problem, okay? All right, number 70, last question for the evening. A lender offers an investor maximum 70% loan to value loan on the appraised value of a property. If the investor pays $230,000 for the property, and this is 15% more than the appraised value, how much will the investor have to pay as a down payment? Okay, so the investor is getting a 70% loan of the appraised value of 230. I'm sorry. So the investor pays 230,000 for the property, and this is 15% more than the appraised value. So you got to use the T formula. So first we got to find out what is the appraised value, right? First, the sales price is, so 100% would be 230, right? The appraised value. However, he's paying 15% more. So that is 115% that he's paying. So that's how we're going to find out what the actual appraised value is. So using the T formula, okay, we've got 230, that's the part, because that's 15% over than the appraised value. And on the bottom, you have 115,000. I'm sorry, 115%. So 0.115 is divided into 230. And you get what? 200,000. Okay. The lender will lend 140,000, which is 70% of the appraised value, which is 200,000. So how much does he have to come up with? So 230,000 is what he's paying, minus the loan amount, which is 140,000, leaves what? 90,000. Oh, who said 69,000? No, so you've got 230,000 divided by 115%, okay? 1.15 divided into 130,000 gives us a smaller amount. The appraised value is smaller. It is 200,000. So 70% of 200,000 is 140. So the lender is loaning 140. So he's paying 230. So 130 from 140 is 90,000. It's harder to see it verbally. You have to see it in writing. That's why I recommend everybody to either use your calculator. I like to do it the old-fashioned way, pencil and paper. However, I also can calculate some of it on my mind just because I like math. Okay. So again, should I go over this question again? So lender offers an investor a maximum of 70,000 loan to value on the appraised value of a property. Now, the investor pays 230 for the property, and that is 15% above the appraised value. So it's 115% above. I mean, it's 115%. So the whole is what we're looking for. So we have the part 230, that's above from the whole on the T formula. We have the part And the bottom, we have the whole times the rate or the percentage, right, on the T formula. So we're dividing not by 15%, not by 85%. It's 115% value, okay, the property. He's paying 230. So it's 15% over the appraised value. So 230 divided by 115%, 1.15 gives us 200,000. So that is the whole. That is the appraised value. Now, from the appraised value, the lender is loaning 70%. So that loan amount is 140. So 140 from 230 is 90,000. You need to learn my way. It can be confusing, okay, but the T formula is what you would need for this question. Okay, use the T formula. And if you don't remember it, just Google it. Okay, Google it and it'll tell you what the T formula is. Okay, so the T formula is part divided by rate times whole. It can be written three different ways, okay? And so the part here on this problem, the part equals 230K. Okay, that is the part. The rate is 115%. And why do I say 115%? Because the question says it is 15% more than the appraised value. So the whole is 100%. Okay? So the rate equals 115%. The whole is what equals X. That's what we're looking for. Okay? So then it's the part divided by rate equals 230K divided by 1.15, 115%. Okay, and that's going to equal the whole. Okay, so then X equals 200,000. Okay, and X is the whole and the part. All right, and then 200,000 times 70% equals 140K. And then 140K minus, 230K minus 140K. So it is the amount that he's buying it for minus the loan leaves 90K down payment. Okay, so that's how you come up with it. Now on your calculator, you might be able to come up with it quicker. However, so we have, so you use the T formula. The T formula is part divided by rate times whole. The part equals 230,000 in this question. The rate equals 15 plus 100. It's 115%. Okay, because he paid more than the appraised value. And we're looking for the whole. okay, in the T formula. So part divided by the rate is excuse me. Okay, so part divided by the rate is 250. 230 divided by 115%, which is 1.15. That'll give us 200,000, which is the whole in the formula of the T. 200,000 times 70% equals 140K. Okay, and then 230, what the investor is paying, minus the loan of 140K means he's got to bring 90,000 down payment in. Sonia says, okay, awesome, very good. Okay, did you all follow that? You can rewatch this so that you can see the formula, how I did it on there, but go study the T formula. The T formula is used in a lot of the math and finance questions. So you want to practice that. And it's one of the most important questions on there. We talked about square feet, acres, length times width. The frontage is what is on the street. Okay, and then the depth is the length of the property going into the interior of the property to the back of the property. All right, and you have to study vocabulary, the finances. What were some of the other things? I forget all the other questions we went through. Okay, but I did mention to go back and study your financing, your mortgage, your loans, your secondary market, primary market. So a lot of review of that on this particular exam. So this is the second session of an exam. We did 25 questions on this one. And we also did video number 1 in the series. So I created a Texas real estate exam series playlist, and it'll have probably 3 videos, okay, of a sample test, sample exam, similar to the exam that you will take on exam day. This one has the national and state mixed, but on your actual exam, your national will be one part. You'll take that, finish it, and then you go to your state exam and do that. You can no longer go back to the national. Remember to review all your questions more than once should you have time, but not too much time, okay, because you have 2 separate exams. If some of you are only taking the state, well, then awesome. Okay, because some of you already passed the national and some of you may have already passed the state. So whichever it is, go practice what? Practice, practice, practice. Questions, questions, questions. After you learn lots of vocabulary, vocabulary, and vocabulary. All right. So that's what you need in order to prepare and pass your exams. And practice them until you get 100% score on your questions. Repeat them over and over. That's what I do even when I practice questions now. The more I repeat the questions to get 100 score, the quicker I answer them the second and third time around. Okay? And study in short spurts, 20 to 30 minutes at a time. You remember the beginning and the end of every study session. That's what I've learned from a gentleman, Jim Quick, on YouTube. Okay? So let's see, the crypto. I really cannot answer that, Crypto Don. I have not used either one. However, there are a lot of students that have used both Real Estate Express and Aceable Agent. I would evaluate first, check out some samples that you might try. Okay, I know Aceable Agent is supported by Prep Agent. Him and Prep Agent, Aceable Agent and Prep Agent are partners, affiliates. Real Estate Express, sometimes you can get a major discount on Groupon. All right, and they're both online. Aceable Agent, I understand, is very user-friendly to use it on your phone. I'm sure Real Estate Express is, but it may be a lot easier on the computer. Okay, it depends on which method or what's important to you, the cost or are you visual? Do you like pictures or PDF? What works best for you? Every individual is different. So that's a great question to Crypto Dan or Don. However, I cannot give you a straightforward answer because I have not used either. I used Train Agents when I took mine because they had slide presentations and I like pictures. I am visual, okay? And they had somebody that I can ask questions to. I may not get the questions answered immediately, but there was a little chat box and I can do it that way. I'm not big on just reading black and white PDF documents. I like some interaction. I like some color. I like slides. So it just depends what works best for you. And Train Agents was cheaper than most all the other ones when I took it back in 2013. Okay. I know Real Estate Express is really good. I do recommend it. And Aceable Agent. Okay. I took Aceable driving test and I really liked it on my phone. Okay. To take the driving course, I took Aceable Agent for driving courses and it works great. I liked it for that. User-friendly, easy to use on my phone and on the computer. You're very welcome, Crypto Don. So any questions before we call it a night? In the meantime, remember, this is Wow Lillie Hendy coming to you from San Antonio, Texas with whom? YouTube Agent Prep. And I'm also on Facebook Agent Prep, but I prefer that you watch on YouTube Agent Prep the analytics, okay, on YouTube will help me grow the channel. YouTube will then promote it more. So come watch the replays on YouTube versus on Facebook and tap that subscribe button if you have not done so yet. And then click that little bell so you're the first to get notified every time I go live Monday, Wednesday, and Saturdays. And tap the like button, okay? The thumbs up if you found this useful. No thumbs down, please. Give me some thumbs up. Send me some love so that I can continue. See, Cindy Cook asked me if I could do a third day. I love that. I'm doing a third day. So send me some love, some support, and I'll continue helping you prepare to do what? Pass that exam. So affirm, I passed, I passed, I passed. And you become a realtor and have your real estate business. Okay. And then you have to select a broker. I'm a real estate agent with eXp Realty, and I would love to interview you to see if we are the solution for you. We're not for everybody. Okay. But Colin here is with eXp, okay, in California and getting his Texas license. And I believe Jay Lean also knows some eXp realtors in Houston. It is not only for experienced realtors. eXp is also for beginning realtors. We have mentors that are chosen in your area. We have lots of training and education. We are a virtual company. We're on the cloud, okay? Almost like a streaming company, like Netflix, okay? Amazon. We're the real estate company of today. We're the Amazon, the Netflix of today. And we own our own software. We also have insurance that you can purchase that will save you money compared to other companies. And we have many other vendors, but lots and lots of training from top producing realtors all over the United States, all over the world. You interact with them in our virtual world, which is called eXp World with Verbella. And we provide lots and lots of tools for only $85 a month. Okay. That is all you have to pay per month. Just realize that when you're starting your real estate business, you've got applications to pay to the MLS, TAR, NAR, then to the broker. Then you've got to get your apps and, signs and all kinds of stuff. So in a year, you could pay at least $1,000 on MLS and association fees and monthly fees. There's also the quarterly fee that you pay to the MLS to have access to all the properties that are listed by all realtors. So that is paid. That is charged monthly. However, we pay for it quarterly. And then you have your monthly charge fee from the broker. And that's typical with all brokers. Some brokers, you have to pay a franchise fee. We do not have a franchise fee. We also reward our realtors with stocks and other monies because we don't have a brick and mortar office. Okay, so the company has more monies to share with those that are part of EXP. You become an owner of EXP the first time, or a shareholder of EXP the first time you get awarded stock, the first deal every year. So you want to learn more about EXP, give me a jingle, send me a text, post a message on YouTube. And with that said, until next time, which will be Wednesday, catch you all later. Thank you so much. Love ya. Definitely will always hit that thumbs up. Awesome. Love it. Love it. Yay.